If you want to retire using options, then the strategy I'm going to mention in this video is one that you must know. This is the exact strategy I use to generate over $9,000 a month in option trading cash flow. So today I'm going to break everything down for you so you know exactly how to do this trade. Here's a quick summary of what we're going to review in this video. First, for those that are newer, I'm going to tell you exactly what options are. I'm then going to talk through what option selling is and how it works. I'm then going to share in detail with you the core option trading strategy that I use. I'm going to show you exactly how to enter this option trade, and I'm then going to show you how to manage the risk or how to manage the exit of this trade. So by the end of this video, you'll be able to place this option trade with confidence all by yourself. Let's get started. Before we get into all the details of my exact strategy, I first want to make sure that we're all on the same page when I say selling options. So first, what are selling options? Well, simply put, when you sell options, you're selling someone insurance, or you're playing the odds that a stock or an ETF is going to act a certain way. And keep in mind that you can buy and sell options. And here's a quick breakdown of what that looks like. So as you see here, there's two types of options. There are call options and there are put options. Now you would buy a call option if you think that the stock is going to go up in price. And you would buy a put option if you thought the stock was going to go down in price. So you do the opposite if you were selling options. You could consider selling a call option if you thought the stock was going to stay below a certain level. And it'd be appropriate to sell a put option if you thought a stock or ETF was going to stay above a certain level. I know I went through that kind of fast, so if you need to hear that again, just please rewind it and I'll be right here when you get back to me. Now for this strategy, we're not going to focus on buying and selling options. We're going to focus on selling options. And we're going to do this in a way that generates consistent monthly cash flow. But why is selling put options so profitable? Well, it's because there's a lot of ways you can make money when you sell that put option. For example, as you see here, when you sell a put option, you can make money if the stock goes up in price. You can also make money if the stock goes sideways or doesn't go anywhere. And you can even make money if the stock declines but stays above the strike price of the put option you sold. Really, the only time you get hurt if you sell a put option is if the stock crashes below the strike price of the put option you sold. So that means if done properly, there's a very high percentage chance that you're going to win when you sell put options. Now that you understand the basics of option trading, let's talk through my exact strategy that I use to generate consistent monthly cash flow. I'm going to show you the two ways I like to do this trade. And then at the end, I'm going to show you a kicker or a way that you can spice things up if you choose to. So you're actually going to get 3 ways to trade my main option strategy. As always, I'm going to use a real life position that I was in to help explain this strategy to you. Let's first go back to the day I did this trade. Let me explain why I did the trade, because I want you to understand the whole process about this strategy. Here you see the hourly chart of NVS. As you see here, for a while, NVS just kind of traded sideways, but then it broke out above that resistance line or above that $100 area. At that point, it turned bullish. On this hourly chart, it made several new highs and several new higher lows. So overall, I felt good about the hourly chart of NVS. What about the daily chart, a little bit longer time frame? As you see on this daily chart, it had been in a pretty sharp decline. But after finding support around that $96 area, it then broke through that diagonal resistance right in this area right in here. And at that point, it began to climb. Because of this new bullish look to the chart, I decided I felt comfortable selling a cash secured put option. So as you see on February 3rd, I sold the NVS March 21st $100 cash secured put option. We got nice premium. We got $1.57 per share. Now keep in mind what's going on here. We sold someone a put option. So we sold someone insurance. So that insurance was right down here at this $100 strike price. So in other words, since we sold a put option, remember that when you sell a put option, you want the stock to stay above that strike price. So basically, I wanted NVS to stay above $100 per share from the day I sold this option to the day I either let it expire or the day I closed it out. And I felt pretty good about that because it had broke out above this green 50 moving average. And if it came back down here to this $100 area, well, I expected to find support because that was an area that previously served as resistance for it. So remember what I did here. It's February 3rd, and I sold the March 21st $100 put option. So I sold the option that expired in about 5 to 6 weeks from the date that I sold it. So a relatively short time frame option. So basically, I'm just giving someone insurance for about 5 to 6 weeks. Well, what happened? Here's a chart up to the day that I closed it out. This little yellow area right in here, that's the day I closed it out. And notice what NVS did. It kind of meandered around, but notice that it was meandering higher. It was making higher highs and higher lows. In fact, a few days before I closed it out, it just made a new higher high. It then came back down and made a new higher low. See the low right in here? This low right in here was higher than this one. So everything was still looking good. But fast forward to March 18th, with there only being a couple of days until expiration, and the stock trading pretty far away from our $100 strike price, I bought it back for 5 cents per share. So overall, a nice, easy win on a company that I believe was undervalued at the time that I sold the put option. So remember what I did here, because this is strategy or technique number 1 of my strategy. I sold a put option that expired in about a month or 2 from the day I sold it. Now let's put a little twist on this picture. Let's change this up a little bit. Let me show you another way I like to sell cash secured put options. SMCI is a company that I believe had gotten really hammered down kind of unreasonably. Now I did this chart way over here on the right side where you see this yellow arrow, but notice what had happened over the previous about year. It was down over 70%. Now the company did have some issues it was working through, but overall, I thought at this price, well, I couldn't go wrong. Or if it did go wrong, I wouldn't lose a whole lot. So I decided to sell a cash secured put option against SMCI, but I did it with a little bit of a twist compared to what I just showed you a minute ago. Here's what I did. This time, instead of selling a shorter dated option or one that expires in about 30 to 60 days, I sold a longer dated option. Notice I did this trade on January 22nd of 2025. Notice the put option I sold. I sold the December 18th of 2026 $13 put options. And I did 3 of those guys. So understand what's going on here. This option doesn't expire for almost 2 years. I mean, it's literally like 1 month shy of 2 years. And notice I sold that $13 strike price. If we go back to our chart here, you see that $13 strike price that I sold, it's over 60% out of the money. That means SMCI would have to drop 60 more percent before that put option was challenged. But I gave the person some time for that insurance. You see, I sold it almost 2 years into the future. On a company like SMCI that's really beaten down in price, has experienced a really sharp, prolonged decline, even if I think it's leveling off like I thought SMCI was, I will still consider selling a put option that's farther out in time. That gives the position more time for it to head my way. I did spice this trade up just a little bit more. I didn't just sell the put option, I did something with that cash right away. Notice I used that cash to buy that same expiration day, December 18th of 2026, $75 call option. So remember, if you buy a call option, you want the stock to go up. So I sold somebody a put option down here. I used that cash to buy a call option up here. So I was really pretty bullish on SMCI, and I wanted to buy that bullish stance. I wanted to pay for it by selling some insurance. And that's exactly what I did here. Notice that even though I bought that call option, I still walked away with $65 in my pocket. I won't go into any more detail about this type of trade. It's known as a risk reversal. I have several videos about risk reversals on my YouTube channel, so please feel free to check it out. But I wanted to share with you that, notice this is a longer term trade. But notice what happened with this trade. Yes, it is a 23-month trade, but I didn't stay in it for nearly 23 months. In fact, here's what happened. Now remember the date. We did this on January 22nd of 2025. I've now switched over to the hourly chart of SMCI. This little yellow area here, that's when I bought those put options back. And here's why I bought them back. Notice that over the previous several days, it had a really sharp, nice increase in price. It was in a nice uptrend. If I zoom in here, she was making nice new higher highs and higher lows on this hourly chart. So when I saw that, I went ahead and drew my trend line in there, and I set an alert that if it broke this trend line, I wanted to adjust this position. And that's exactly what happened on February 20th. It broke my trend line, so I adjusted this position. How did I do that? Well, here you see in the trade alert I sent out to my patrons that I bought that put option back. You see here, I bought that SMCI December 18th of 2026 $13 put option back. So I was actually in this almost 2-year option for less than a month. So I bought it back, and how did I pay for it? Because I always wanted to get a credit when I sell these options. Well, I paid for it by selling a $100 call option with that same expiration day. And notice what I got. I got $10.62 per share. So I pocketed over $1,000 for this trade alone. I closed out that insurance that I'd have to be in for another, what is that, about 22 months? And I set myself up for an additional win if SMCI went up. And how did I do that? Well, remember, when I entered this trade initially, I bought the $75 call option. And to help fund closing this put option out, I sold the $100 call option. So now I own that spread. I own the $75 call option here. I've sold the $100. So I have a spread of $25 I can still make per share if SMCI is above $100 per share at expiration. Now, of course, I can close this out early, and I'm looking for the opportunity to do that. I'm sorry if that was kind of complicated for some of you. I want to keep this video simple, but I kind of get excited when I talk about some of these positions. But the main thing I wanted to share with you is that I didn't sell a shorter dated put option. I sold a longer dated option, but I closed it out way early. So if you want to give yourself some room to be wrong, remember we had 60% between where the stock was trading at and our strike price here. So if you want to give yourself some room to be wrong and still pocket some nice premium, and you're okay with possibly staying in a position for a longer period of time, then maybe consider selling some longer dated put options. In this case, I sold options that expired in 23 months. Now just a word of caution here before I move on to that extra bonus, that kicker I promised you at the beginning of this video. I know this probably looks really easy as I'm talking through it, but please make sure you understand the risk that you're taking before you place any trade. There's risk in absolutely every trade you do, every investment you do. So you need to make sure you understand all the risk. You will lose money in trading. But if you understand the risk, then you're prepared financially and mentally to deal with those losses. And just also know that there are ways to deal with positions that go against you. I have a whole video series dedicated to repairing option positions that go against you. So if you're having a problem with some positions, check out that playlist. I think it'll really help you out. All right, now let's move on to the kicker. Now I'm going to reveal something about myself. One thing I really like in life is boring. Now, I don't like a boring life. I like an adventurous life, but I love boring stocks. And here you see a really boring stock. It's ticker symbol BDX. How boring is this thing? Well, notice that over the past about year and a half, it's pretty much gone nowhere. I mean, it's kind of like a sloth of stocks. It moves so slow. And it stays in a nice range. Notice here the high is around 250, the low is around 218. So really not that big of a range. When it gets down here, it tends to bounce up. When it gets up here, it tends to bounce down. And in fact, usually, I can pull this line down a little bit, usually it finds resistance around 245. So this range is really just a little over 10%. That's over the past year and a half. But it is the perfect boring stock for the next strategy I'm going to share with you. And it's a little bit of a different play on what I've already shared with you. This strategy sells a put option like I've been showing you, but it does something extra. It also sells a call option. And it's perfect for stocks that are stuck in a nice range. So here's what you might consider if you understand the risk. I'm going grandpa on you, I'm telling you about the risk, but I'm also going to tell you about the reward. So if you think a stock will be stuck in a range, you might consider doing a strangle. Here's how you do it. You sell a put option at an area where you think the stock will not go down to, and then you sell a call option at a spot where you think the stock will not go up to. As you see here, as long as that stock stays between those two prices, then you get a win. Now you do want to be prepared to deal with it if it goes against you, and there are ways to do that. I won't mention them in this video, but you do want to be prepared for that. So before you enter a strangle, make sure you understand what your game plan is if things go wrong. But do you see why this strangle strategy might be good in a sideways or slightly bullish or slightly bearish market? Because you're collecting two premiums on the same stock. So technically, you can only lose on one side if you enter and exit both of them at the same time. And you can trade these strangles in really almost any type of stock or ETF that you think is going to kind of be range bound. Here's a nice example of one, it's BDX. It's stuck in a nice range. It tends to find resistance around 245. It tends to find support around 220. So this is actually a really good candidate to do a strangle in. So let's talk through exactly how we might set this up. Well, if I were to consider doing a strangle, number one, I want to make sure that earnings were not coming up. See, I don't want to trade that strangle through earnings if at all possible. I then would sell a call option above where I think the stock will be during that expiration period, and I sell a put option below where I think the stock would be during that same expiration period. And of course, if you trade an ETF, you don't have to worry about earnings. You can do this in SPY or QQQ or IWM. But if you're going to trade it in a stock, just make sure you're careful on earnings because companies can get really volatile and move a lot of distance through earnings. Let's look at a possible strangle we could place on an ETF like SPY, the S&P 500. Let's kind of get our bearings here. So right now the S&P 500 has been trading for a low of around 545. It's been finding resistance right around here around 577 or 580. Now this is not a trade I'm going to do, so it's not a trade suggestion. Let's say you thought it'd be stuck in that range for about another month. How would you set up this strangle? So here's a possible trade you could consider if you thought SPY would be stuck in that range. So remember, we think it's going to be above 545 over the next approximate month. We thought it'd be below 580. Well, we could consider selling the 545 put option that expires in 44 days. We could then consider selling the 580 call option that expires in that same 44 days. And notice what we get for this. Now, right now, the market is a little bit volatile, so probably a little more than what you typically would get, but it says we get around $14 per share, or basically $1,400 for doing this trade. Now, if you wanted to give yourself some insurance, you can always buy a put option below the strike price of the one you're selling. You can also buy a call option above the strike price of the call that you're selling. So I give you a cap on what you might lose if the position goes against you. Now, let's say we did this trade. What then? Well, we obviously want to keep an eye on it because if SPY goes above our 580 strike price, we could begin to lose money. If it goes below that 545 strike price, we could begin to lose money. So we want to make sure that we're monitoring it. And what are we looking for when we're monitoring it? This is where you got to make some decisions. How much profit do you want to have? For trades like this, I tend to want to exit them whenever I've realized about 50 to 90% of my profit. Now it's a big range, but you got to decide for yourself. Obviously, if you go with a lower percentage profit like 50%, you'll probably be out earlier. So that's if everything goes great. Now what if the barn burns down? What if bad things happen? The market crashes or the market goes way up in price? How do you get out when it doesn't go your way? Well, that's where stop loss comes in. So you're receiving $14 per share, about $1,400 when you enter this trade. When might you get out because it's losing money? Well, typically my personal rule is that I'll look to get out when the position is down about the amount of credit I received, or at worst, when it's out 2 times that credit. Because think about what that means. Remember, we received $1,400 up front when we did this trade. If we lose $2,800 or twice the credit we received, that means we have to have 2 complete winning trades just to get back to break even. You see, what you don't want is for the position to go way against you. You end up needing like 10 or 15 or 20 completely winning trades to get your money back. So by having that stop loss in there, it triggers you to get out of the position if it goes against you. It lets you fight another day, which is very important if you're trading this type of trade. Risk management is a vital part of being a successful option trader. So please make sure you have a risk management plan in place before you place any option trade. That's what the pros do. And if you're gonna be a pro, that's what you have to do. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. Selling put options is one of my absolute favorite ways to generate consistent monthly cash flow. If you want to see more details about how I've been trading put options for over 20 years I've been doing this, check out the video series at the link above and the description below entitled Selling Put Options Explained with Real Life Examples. Until next time, happy investing, and we'll see you again soon.